Welcome to FinBot Insights. Today, we're going to break down one of the most destructive biases in all of finance, the sunk cost fallacy. It's a powerful psychological trap, one that causes even the smartest people to make completely irrational decisions with their money. This is the question that haunts every single investor, right? Especially when you're looking at a portfolio that's just bleeding value. Suddenly, the decision stops being about finance, and it becomes this really painful, emotionally charged dilemma. So to really understand just how damaging this fallacy can be, we're going to look at a real-world portfolio. Now, the numbers you're about to see, they aren't hypothetical. They show the harsh reality that, unfortunately, a lot of investors have had to face, a reality that's almost always avoidable. Okay, so let's start by exploring the core of this dilemma. It's all about how that original price you paid for something just sticks in your mind. It becomes an anchor for all your future decisions, and that single cognitive bias can have absolutely catastrophic financial results. When you look at the assets that are still left in this portfolio, the destruction of value is just staggering. And this huge gap between what was paid and what they're worth now, well, that creates a massive emotional wall that makes it feel almost impossible to sell and accept the loss. And this is the kind of thing people tell themselves, isn't it? It's only a paper loss. But really, this justification is a form of self-delusion. It's a comforting story we tell ourselves to avoid the pain of being wrong, but it's a story that dangerously twists our perception of financial reality. So you have to wonder, how does an investor even get to this point? How do you end up with a portfolio that's made up entirely of losers? Well, it happens because of a specific strategy, one that seems perfectly logical on the surface, but is actually built on a fatal flaw. Here's the strategy. You systematically sell your winners to lock in those nice profits, and you hold on to your losers to avoid admitting defeat. It feels good, right? You get the pleasure of taking profits, and you get to avoid the pain of realizing a loss. The problem is the outcome of this strategy is mathematically guaranteed, and it is financially disastrous. And what's the end result? It's guaranteed. Over time, your entire portfolio will be made up of nothing but your losing investments. You're left holding a collection of assets that you would never, ever dream of buying today. Your portfolio literally becomes a museum of your past mistakes. You know, there's a reason professional fund managers are legally forbidden from this kind of thinking. It's a practice called marking to market, and it forces them to value their assets based on today's price, not what they originally paid. Why? Because using the original cost would be wildly deceptive. So this whole concept of a paper loss, it's a complete fiction, and a dangerous one at that. The market's current price is the reality. That money is already gone from your net worth. It doesn't matter if you've clicked the sell button or not. Okay, so how do you escape this trap? It requires a pretty fundamental shift in how you think. It all starts with asking the right question. You have to stop looking backward at the past and start looking forward to the future. So, should your decision be based on how much you're up or how much you're down? This is where people get it wrong. The answer is neither. That price you paid in the past is completely irrelevant to an asset's future potential. Anchoring to it isn't rational analysis. It's just an emotional reaction. The correct question to ask yourself is this: why did I buy this in the first place? Shifting to this question is the single most important step you can take toward making truly rational, forward-looking decisions. It forces you to evaluate an investment based on its merits today, not its past. Now, to reevaluate your original idea or thesis, you really need to understand what makes an asset's price move in the first place. These price changes aren't random. They're usually caused by one of four key drivers. An asset's price all comes down to demand, and that demand is really driven by these four things. So think back. Did you buy it because you thought it was fundamentally undervalued? Or maybe you were expecting some good news, like a great earnings report? Or were you just riding the wave of market momentum, the greater fool theory, hoping someone else would buy it from you for more? Figuring out which of these was your reason is absolutely key to doing a clear-eyed analysis now. All right, let's put all of this together into a practical framework you can actually use. This is a simple, repeatable process that's designed to take all the emotion and bias out of the decision to sell. It's a really logical, unemotional review. First, you go back and re-examine your original reason for buying the asset. Step 2, you have to honestly ask yourself, does that reason still hold up today, based on everything I know now? If it doesn't, step 3 is to ask, okay, has a new, equally good reason to own it come along? And if the answer to both of those questions is no, well, then the logical action is to sell. It's that simple. This process is all about adapting to new information, which is probably the most critical skill any successful investor can have. So, we'll leave you with this final thought to really guide your decisions from here on out. Is your investment process designed to simply confirm your past decisions, or is it designed to adapt to new information? Your honest answer to that question will probably determine whether your strategy is built for long-term growth or if it's destined to fail. Thank you for joining us for this explainer from Finbot Insights. If you found this analysis valuable, we'd really appreciate it if you'd click like and subscribe for more content. Your support really helps us create more deep dives into the essential mental models you need for successful investing.